How's it going, everyone? And as always, welcome back to Continues to Tick. So initially I figured I'd complete part 2 of my short series on why it is I won't retire as early as I initially thought with dividend investing, thus getting into the more nitty-gritty from part 1, explaining more in detail how it is I have a guaranteed comfortable retirement at the age of 50, which is not as soon as I would like, but it's still early, at least on my current path. But that'll have to wait for next week, so do stay tuned. But rather this week I felt the need to make a more important video. As by the title name notes, we reached a pretty awesome milestone, the $1,000 a year in dividends mark. And well, considering the markets, along with my portfolio lately, having taken a beating over these last couple weeks, the dividends haven't, which further validates the reasoning behind this strategy. Therefore, I figured I had to recognize and share this moment with you all. As many of you've seen me from the beginning, and we've come a notable distance since then. And although the path I'm on is a long one, a long road coming, it's just nice to see these stepping stones hit accomplishment status. So with this, similar to my other milestone videos, once we get into the portfolio review, we'll go a bit further in detail than we normally do, such as sharing with you the portfolio size in comparison to the dividend yield, my sector allocations, their percentages, my total number of holdings, and so on and so forth. So let's begin. However, hopefully we can first take this moment as a gentle reminder to like the video, and well, maybe consider subscribing to this story. As I've proven over time, I won't be stopping anytime soon. Fun fact actually, we're on video number 63 today. And well, if not for any of these reasons, how about for the fact that here's a snapshot of my very first dividend payout of 8 pennies back on August 13th, 2020. A long road coming indeed. You see, I started this dividend portfolio back on July 20th of 2020 at the age of 24. Then on August 25th of 2020, I decided to start this YouTube channel and start documenting my story. And well, by that time I had already turned 25. And then here I am today, now having turned 26. And well, if there's nothing else to have gained from any of this series thus far, I hope to, so far at least, have truthfully reflected through my own story that, as easy as it may seem sometimes, to just not notice, time does pass. Thus, it's important to be aware and cognizant of it. Use it methodically, purposefully, and although tomorrow isn't guaranteed, even less of a guarantee is getting a second chance at yesterday. I mean, call me an excessive word user or an odd storyline creator, but as far as I know, from my 26 years on this planet, I haven't heard of the ability to go back in time. As a short example, my dad turned 66 years old this weekend, and I imagined he'd like some time back. But as I know he has, I will continue to learn from those in front of me, directly or indirectly, as much as I can. It'll save you a lot of pain, a lot of lost time. My dad instilled a lot of this mindset in me, and in a rather convoluted way, I'm so grateful my father is still here, and I can continue to have a relationship with him. But it does sadden me that another year for me doesn't mean too much, as it must mean for him, hitting 66. After all, as I continue to climb, he continues to fall. And it's a learning experience to see him age in front of me, as it is for him to be aged and watch me aging and stepping into my own. But honestly, before I know, that'll also be me, if lucky. And we can add quotes to that, if lucky. I mean, when I first started this YouTube channel, I created this video watching my father age, as he recently turned the age of 65. Well, it's been a year now, and man, does time really go by this fast? I'll go ahead and answer that for myself. It does. It does. So switching gears a bit, as they say, let's go into the more important part of this week's video, breaking down my portfolio and how it looks when you have a dividend portfolio that pays you $1,000 a year in dividends. So here we are currently in the Jesse's cash flow portfolio. But first, let me prove to you that I do in fact have a dividend portfolio that pays me $1,000 a year. So this is the DivTracker app that I use. It's literally called the DivTracker app if you're curious. It's actually really neat to see the reaching of this mark, because if you've seen my other milestone videos, we've been working to hit this mark for a while. And now, well, here we are. And the only thing that's changed has been time. And actually, since we're here, let me go ahead and update my new goal for an annual dividend income goal. Previously, I had it set at $1,000. How about we go ahead and let's set it at $2,000. 51% reached. Says we have to invest about $31,000 more to get to that at the current portfolio's yield. So let's see how long that takes us. Maybe another year or so, hopefully a little less. And as you can see here from this screen, according to the DivTracker, this portfolio that pays $1,000 on an annual basis of dividends has a current yield of 3.14%. And if we break it down on a monthly basis, it currently pays us $84.77. And if you want to go a little deeper, break it down by day, $2.79. Not too bad. Not too bad. But now back to the M1 portfolio. Here we are, similar to the sum on the DivTracker, just off by a few pennies, but a total of $36,330 nonetheless. So take a note. A portfolio of this size produces $1,000 a year in dividends. I know I had that question when I first began. The question of how big does a portfolio typically need to be to get $1,000 a year in return? Well, here's just one example of an answer to that. And with this, we currently sit with a return of 30.23%, which equates to a total gain here on the M1 portfolio of $4,685.96. Of this, from market gain alone, is $4,032. And here we are, with an earned dividends amount on the all-time charts of $653.78. And it's pretty neat to see that climb continue upwards. And considering this is a milestone video, let me remind you, you can always check out my pie on your own time with the M1 link in the description box down below. But as I typically do, I'll break down my sectors here briefly with the percentage and which holdings I have in each sector. And if you have any questions, definitely leave a comment down below. But here we start with real estate, which is set to 13% of the dividend portfolio. It's one of my largest sectors here. It holds Avalon Bay Communities, Digital Realty Trust, American Tower Core, and Essex. And it looks like Avalon Bay is taking the lead in terms of overall percentage return. Next up, we have consumer staples, which I've set to 12% allocation here in the portfolio. And when we click on it here, we have Walgreens, Archer Daniels Midland, PepsiCo, Procter & Gamble, J.M. Smucker, and Philip Morris. And it looks like the leading performer of this sector happens to be Philip Morris. And as we move along here, we have tech set at 10%. And if we take a look into this sector here, we have Nvidia, Apple, Visa, Oracle, IBM, and Cisco. And if we look at the leading performer of this sector, we have Nvidia, which has been a guarantee for quite a couple months for sure. It's interesting to see that I do have a target percentage of 28%, and the actual percentage is actually way above that. So Nvidia is one that just does not stop. A lot of growth in that individual stock so far. So following tech here, we have my ETF, which is 10% of the portfolio, and it's SPYD if you're curious. And it has a 38.62% return. So along with my SPYD, I also have the index fund that I also hold, so combined together it's about 20% of the portfolio. And this is VIG, and it currently has a return of 24.82%. Next up here, we're on utilities, set at 10% of the portfolio. And when we take a deeper look here, we have a couple. We have Southwest Gas Holdings, UGI, MDU, Sempra Energy, American Water Works, Duke Energy, Alliant Energy, and the Southern Company. So quite a bit here. But I do like to be diversified, especially when it comes to utilities. And it looks like the leading performer here is American Water Works. Following utilities, we're now taking a slight dip with financials set at 9% of the portfolio. And when we look into financials, we have JP Morgan Chase, CTBI, Aflac, and Chubb. And it might be to no one's surprise that JP Morgan Chase is the leading performer in this sector at 61.98%. Next up, we have industrials, set at 8% of my portfolio. And surprisingly, this one has a red performer, Lockheed Martin Core. But in addition to LMT, we have McGrath RentCorp, General Dynamics, 3M, ABM, Snap-on, and Waste Management. And it looks like the leading performer in this sector is Waste Management. Next up, we have healthcare, set at 7% of my portfolio. And if we look in here, we have 3 holdings. We have Medtronic, Johnson & Johnson, and Pfizer. And it looks like Pfizer is leading the way in this sector at nearly about 40%. Next up, we have communications, and we're taking a slight dip here from the 7% as it was prior at 5%. And in here we have Verizon, AT&T, Omnicom, and Comcast. So 2 more red performers with Verizon and AT&T. But it looks like the leading performer in here is Omnicom at 39.67%. Next up, we have energy, which I've set to 3% allocation in the portfolio. And we have Chevron in here, ExxonMobil, and NextEra Energy. And we have Exxon easily leading the way at 63.32% return. Almost towards the end here, we have materials set at 2%. And in here we have Sunoco and Sherwin-Williams. And Sherwin-Williams is leading the way at 36.11%. And if you've been following me for a while, you know that in consumer discretionary, I just hold one stock in there. And it's definitely one of my favorites. It's McDonald's. And they have a 26.55%. I'm loving it. Sorry, I had to. Next, here we are with a display of some of my portfolio statistics, according to M1 Finance. So for those that are curious, unless you were counting every single one along the way, we have a total of 51 in the Jesse's cash flow portfolio. And we currently have a dividend yield, according to M1 Finance, of 2.823%. So if you remember on the DivTracker, it was about 3.15%. A noticeable difference in both of those. When I look at both, I would just imagine it has to be somewhere in the middle. But who knows? Regardless, it's a dividend yield that I'm pretty comfortable with. Anywhere between 2.8 and 3.1, 3.2. That's pretty good with me. And if you're curious about my expense ratio, it's pretty much almost nothing at 0.01%. And as we make our way to closing out this week's video, here we are in the dividend activity for this past week. Starting on September 22nd, getting paid dividends by SBYD of a pretty good amount of $35.08. And here we are on September 23rd, getting paid by Nvidia 22 cents. And then also VIG $15.83. And here's our second snowball for the week. A lot bigger than $12 at $34.63. So $34 combined with $12. We have 46, and then you count the pennies, $47. $47 snowball we had this week. And then last but not least, on September 24th, getting paid by LMT, $3.01. So that's going to be it for this week's video. A little bit more technical, a little bit different style of a video than I normally do, but it was fun to make. I think it's a pretty big deal that, we started with a dividend payout of 8 pennies. And here we are now, finally reaching the $1,000 a year mark in dividends. And it took over a year. It took a portfolio size of $36,000. And for those that aren't dividend investors, you may see it as maybe a trade-off that just isn't worth it. And that's okay. I did my research when it came to investing and finding a plan that works for me, looking into the future and taking other factors into consideration. This is my strategy. And considering how much of a beating my portfolio has been taking over these last couple weeks, the one thing I can always hang my hat on and point to is knowing that my dividends haven't been affected. If anything, I had a $47 snowball this last week. And for the most part, that's money that wasn't even mine to begin with. And ultimately, that's what it's all about. But as always, guys, as we made it through 7 days, we have a high chance of making it through 7 days. So stay tuned for next week's video. It'll be part 2, giving you more of a detailed technical look as to how I actually do plan to retire at 50. And as always, guys, take care and I'll see you on next week's video.